1 week ago, we had a huge sell-off in the market. A few days ago, we're within striking distance of all-time highs. Barely down on the week. Nothing happened. Nothing changed in the markets. Wrong. We got volatility extraordinaire even this morning, but we're back up. We're almost unchanged. Everything is fine. We are here to tell you everything is fine. And we'll discuss some possible things that may or can go wrong. 835 CC Lagator. He's going to guide us to an option expiration. Where is that open interest? What are the bulls going to do? What are the bears going to do? Let's get it started on this Friday. I'm excited. As you can tell, it's pre-market prep.
The volatility right now is really incredible.
Wow, look at that consolidation on the upper right chart.
You know what we've seen this earnings season? Some of these expected moves get even more violent. This is why I have switched my strategy 10 years ago. And if you're chasing, you're in trouble.
Throw out the high, throw out the low. We're down 20 handles. It's 66.49. Buck flat, 98.11. TLT just climbing, making a new high of the move. Highest we've been since April, up 19 cents, 91.58. Someone find a bid in oil, down 33 cents. The USO, 67.48. GLD all over the map, but now down 230, 394. 394 and a quarter. SLV getting hit too, but what a run that's had, down 77 cents at 48.51. And Bitcoin, we talked about Bitcoin. Bitcoin, we need you for the rally. Why are you going down? Bitcoin futures down $2,500, 2.3%, just under 106K. I don't know if Triple D is going to be able to come on right away. He is in a fast market over there.
Yeah, a lot of trading going on. Love the volatility. Love the actual short thesis having something there. It's nice to trade two-sided markets instead of just one way, slowly climb the wall of worry types of trades. We have real worries here, folks, all of a sudden. Bring the Brentster in here, too, to join the conversation. Hi, Brentster. How you doing, buddy?
Good morning. I'm doing well. How you guys doing?
We had a lot of fun in the STN room last night. It was the short trades were working last night. They were working very well. They were working very well overnight here, too. We were down as much as, 80 handles, Joel, at one point in time?
Yes.
We were down 80. So if you were sleeping, you're like, oh, it's just a nothing day. No, we were down 80 more handles. But Taco Friday. Trump. So here is the scenario. I'm telling you, this is what went on behind the scenes. We're down 80 handles. We're down 70 handles. Trump's waking up and he's like, why is the market down so much? And they're like, oh, they're worried about the tariffs. They're worried about, he's like, man, I got to do something. He's like, you know what? He's like, don't worry. We're going to get a tariff deal with China. These high tariffs aren't going to last. And bang, the market gains 70 points. This is called the Trump put, folks. This is what the market
This is the definition.
When the market goes down, Trump comes to defend it. He doesn't even like it going down for a day. I mean, he sees it, and he's talked about this for years. He was using it, to say how good Biden was doing. He was using it, and the market would go down. He's like, this is all on Biden, Back when his first presidency, he always used it, as the standard. Am I doing good or not? Well, the stock market's doing great, so I'm doing great. He hates it when the U.S. stock market is going down. So that is exactly what happened this morning. It's not a coincidence. It happens at 7 a.m. He wakes up, at like 6:30, probably 6:45, looks at, the S&P down 80 handles and says, I got to do something. And he's, then he starts talking and throwing out, tweets. He says 100% tariff is not sustainable. That's what he's saying right now. 100% tariff is not sustainable. So why did you say it? So why is it not sustainable now, but it was sustainable a week ago? Obviously it's the art of the deal. We know that it's not sustainable. But now he's like, crap. He's like, it's going down here. I feel partially, he doesn't ever feel responsible, but he knows he can save the market. He came in, he saved the market. So this morning, it was ugly. We had regional banking concerns here. That is all gone at this point in time. Does it come back? Well, that's the question. This is a very important day. It is also options expiration, which will get CC Lagator. We see lots of sell imbalances early. But, him stating that 100% tariffs is not sustainable is huge for the market. Huge. Because we had all kinds of other concerns, which we can get to in a second. But Trump just saved this market.
Wow. What does he have for breakfast, Dennis? Does he have a
I don't know what he has for breakfast, but you guys are just are we done? That's the show. That's it.
What else do you need to say? You just you did it all. Let's go out on a high note.
Don't you think that's what happened, Brent?
I think that's probably what happened. Yes, I think that's probably what happened. I think it was notable that the market rebounded to futures rebounded to over the 6,600 level before Trump started saying things. Gives me a little bit of reassurance. I think another part of this too was that Trump confirmed he will meet with Xi in a couple weeks. A few days ago, when Trump was all upset about this, he was like, "Why would I meet with Xi? He doesn't want to talk to me. I don't want to talk to him."
He said everything the market wanted to hear. He came in this morning on a mission to get the market to come back. That was the mission. It was mission save the stock market. You can thank Donald Trump that you're not down 75 handles here this morning because he's on a mission. Everything he's saying fully is the Trump put, what we've been talking about. He will defend the stock market to the death. We are coming back green. This is why it's been such a tough battle for the bears. They start to heat up. They start to get some hope, the bears. They got a regional banking crisis potentially on the table again. Lots of things to chew on here. Trump just harpooned all that. All your shorts, and we're just killing it this morning. I was up a lot on some shorts. Immediately harpooned when Trump woke up and said, "Hey, I don't like the market down, and I'm going to make it go higher." And that's exactly what he did.
On those kind of things, do you try and like throw hedges on first, or do you just try and cover? Because there's no, I mean, they're just
shorts.
Yeah. Okay.
Immediately. Okay. Like you don't wait. You lift offers, like you said. Okay. They don't hit bids when the market's rallying. You got to lift offers. You go in there and you start lifting offers, Joel. That's exactly. I'm still lifting offers. I mean, we're going to go green. We're just down 80 handles. Trump just made this market go green. That's impressive, folks. That's impressive. He is powerful. And he just made this market get all of its losses back. Bang. Donald Trump rally here right now. Taco Friday for all.
Okay. I mean, the evidence is in the market, right? And we're seeing the rally now. What's going to happen in the regular session? Unchanged is always a good level. That's why, pre-market trading, even if you're not in there down and dirty, pulling the trigger and stuff, using it is indications for what's going on. Like, to me, like if we do get green today and we hold green off the open, then look out. If we fail at the close, whatever, first 15 minutes and half hour, then I think we got some downside on it. But boy, the action yesterday too, so choppy. So, it's not the calming down market that you like to see. And as I talk about, when we always have these periods of volatility, when's the market going to calm down? When's there just going to be 2 or 3 days of consolidation? Well, folks, it doesn't look like we're going to end the day or end this week with any kind of consolidation period.
It's option expiration, so it's going to be wild here today, too. I'm just in shock that we got all these losses back. It's unbelievable.
We had one of our smart traders in the STN room talking about a potential idea in Coke last night. Paul was talking about liking Coke here. Coke rallied really nicely overnight. Look what Coke's done in the last hour. Coke sold off.
It's staples. It's staples and they're defensive, but it's starting to leak here now. So it was way up. So Coke, Procter & Gamble, your staples are moving inversely with this market here right now. They were all way up overnight, which they should be. They're defensive. Yeah. So the market was playing full-on defense. So there's offense and defense. As soon as Trump woke up, you had to go offensive and get rid of the defensive stuff. As soon as he woke up and did the first tweet, you're like, oh, crap. If you're short, you're like, this is your tell. Get the hell out of the shorts right now because he is on a mission today. He's still talking. Like he just said 100% tariffs is not sustainable. So he's literally unsaid everything he did. We sold off. How much did we sell off on the Trump, tariff? Go back to that, what was it, Friday? Last Friday?
Yeah.
We sold off the 200 S&P handles. He just unsaid all that. So it's not surprising you're going to get 80 handle rally off of that. He just unsaid all of that. Everything that he said, He just pulled it all back. 100% tariffs, not sustainable. Totally tacos. Totally.
There's cracks in the armor, though. There's other things that are going on.
We can talk about that, and yes, there is, and there's things to worry about, and it's a very important day for the markets. It's important to the bulls that they hold these gains because it should be up by 80 handles on this commentary. We should be, and we are. So that's the good news. The bad news is we were starting to worry about the regional banks, like all out of Zion Bank out of the blue. They're talking about credit concerns. And then we see Jeffries, JEF getting killed and WAL, and the KRE has its worst day in 2 years. And you're like, holy crap, are we going back to 2023? That's what it looked like last night, that we got the potential for a serious sell-off here. Because if those regional banking concerns happen, we know that, that's not much that we can do about it. There are a lot of bad loans in these banks. The market starts focusing there. There are problems there. But you know what? The markets all of a sudden, Trump just took the focus right off of that. So genius that way too, really. I know you can love him or hate him, but this really saved the market this morning. So if there's Trump doesn't do what he does, we're down 80 handles right now, folks, and we're having a completely different discussion. So if Trump just literally said, "Oh, it's just we're 2% off the highs, who cares? I'm not worried about it." No, he is worrying about it because not only is the commentary for China now, that this trade war is not going to be as bad as we think it is. It's also that he's going to defend the market whenever it goes down. That's what we just learned here today. This Trump put is not just alive and well. It is active right now. Like he doesn't want to see the market go down 80 handles. I mean, the market's just rallied thousands of handles. He doesn't want to see it go down at all. So if he's going to come out and defend the market every time it goes down, it's hard to turn around and just short it.
Is that healthy long term, though, Dennis? Is that healthy long term?
None of it's healthy long term, Joe, but nobody cares about the long term anymore. This is the YOLO market. You only live once. Nobody's sitting here and saying, "Oh, I'm paying $19 billion for a quantum company that's sitting in a garage and just trying to put." Nobody's saying that. Nobody cares about that. They only care that the story is hot and I need to make money now because I may not be able to make money tomorrow. There is cracks though. Like Bitcoin, not really rallying much here. Maybe he's going to say something to save Bitcoin too. He might. He might just be looking at Bitcoin and say, "I need to get that up too." That could happen, folks. That's the wild card here. You have a president that is very active in the market and doesn't like stocks going down. That's a good thing for the bears. But that doesn't mean there's not cracks. All kinds of cracks. Bitcoin cracks, regional bank cracks, lots of cracks that weren't there last week have suddenly appeared.
Technically speaking, I'm just going to use the Bitcoin and I'm going to use the S&P. You see how Bitcoin for the last, let's say since mid-August, it spent some time below the 50-day, but then it got back and it got back above it and it went to a new all-time high. And now it's come back down through the 50, so we had warning signs. We didn't know it was going to go back up to an all-time high, but it comes back. Look at the S&P right now. I mean, you are getting some cracks on the 50-day. You got a crack last Friday. You got a crack today. I don't know. We'll talk to CC. I know he likes to use the cash and everything. But could it be that the 50-day starts to be resistance? That we start significantly falling below that level. And that the institutions are like, "Oh, the 50, now we got to worry about the 200-day. And I'll just show you. I mean, here's the 50-day. We always talk about the longer term averages. Let's just take a look to see where that 200-day is. And I don't even know when's the last time, real quick, chat, besides Jay Rice, when's the last time you think we saw the 200-day moving average? April?
Probably
April.
April. April would have been for sure. Bring it up.
Okay. There it is. 6,200. 6,200 in the futures. Is that inconceivable that we go to 6,200?
I can't emphasize how you can do technicals all you want here, but this is headline driven. The technical analysts will say, "Yeah, we got down to 552 or whatever on SPY, and we were going to bounce there because this was a level of they'll find some level." Now it's all nonsense. Not all technicals are nonsense. This headline this morning, though, was all Trump. So we can do charts and we can do all these things all we want. Headline driven market. Headline driven market. This is what really moves stocks. Headlines build the charts. Write that down. Headlines predict the charts. Headlines build the charts. That is what builds charts. It's headlines, folks. Brentster, you know this. You worked on the Benzinga news desk for years. We can have the prettiest chart in the whole world. And when Trump says something like he does on Friday, stocks are going down. When Trump wakes up and is on a mission to make stocks go higher this morning, stocks are going up. So we can look at the chart and say how pretty it all is, or, at this average or that average and everything. But when we're in headline-driven markets, technicals take a back seat. So right now, it's a matter of digestion. It's a matter of looking at what has happened here. I'm back to the fence. I was full on short train last night, and doing well with it. It was an awesome night. But, just got harpooned right through the middle when Trump woke up at 7 a.m. So now what do? Well, we got to wait and see. We got to see what happens here today, because we had the serious sell-off on real concerns. But now Trump has totally, did the taco trade, and now we're seriously rallying here. So we can look at the charts for levels of where we think we could go. So, once you get the news out there, then you can start to look at levels. And that's why I think, it's got value here. Probably look, yesterday's high at 668. Is that in play, Joel? I wouldn't say anything's out of play.
I wouldn't say.
I don't think it is. I don't think it is. But this kind of volatility, I don't think anything's out of play.
I mean, you can't say the high of the day's in, right? It's 60, because we're only 8 handles. And just the way this market's been lately, in the Friday high or low for the week comparison, makes me say I'm not sure the low is in. I mean, it's 90 handles away. I sure hope we don't go down there today. But I mean, it's just, I mean, this market's moving in vacuums. Maybe we can settle down today. We only need to rally. I was just looking at the close from last Friday, because just to give a perspective on things, because we've had all the volatility. So 1 week ago today, on that big down day, so we're up on the week. We closed at 65.95 and a quarter. We're up on the week. What's there to worry about? It's a positive week after a bad week, right? We're positive for the week. Let's see if we can keep that going.
Keep with the news train here. So we got regional bank earnings all over the place, which we can talk about here in a second. And we can talk about those concerns as well, which are serious concerns here. But we do have this AI trade that, is pretty relentless here. But you can just see how much the bears were in control last night, Brentster. Oracle comes out, raises guidance kind of twice. They did it, and then they said it again. Twice. They raised guidance again. So, Brentster, just give us those details there. Because obviously it was analyst day. They were giving commentary. Oracle rips higher. Those rips were quickly sold. What was the news?
So the big number, I'm going off the top of my head here. So the big number when we heard from Oracle, whatever it was a month ago or whatever, was 144 billion in AI data center infrastructure sales. On the webcast midday yesterday, around 1 or 2 p.m., they raised that from 144 billion to 166 billion. Later, they gave total sales guidance, which I think was also raised, not for sure, but they said that in 2030, their total sales are going to be 225 billion. And if you're really drilling down on the chart here, the big move in Oracle yesterday happened when an executive was commenting on gross margins in data center infrastructure. That was the big pop. When they raised the guidance for the 166 billion value, the stock only popped a little bit.
I mean, just trying to give you perspective here, $225 billion in sales. This company is 60 billion in sales right now.
That's crazy.
If they hit that target, the stock is so much higher. And they raised the target from where it popped last week. This was great news, but it was being reported into a tape that didn't want any good news. It just wanted to sell stocks. So Oracle popped up from 313 to 318, 320, and just quickly got sold. And it's down here now again because that's already been priced in. But that just shows you the bears were in complete control last night. I don't know at this point in time if they still are. We're going to find out, obviously with what happens when the market opens at 9:30. Are real money managers, the big guns, when they come in, are they coming in and saying, I'm a little bit nervous and take some profits? Or are they we got the Trump put, we'll just blindly buy stocks? I don't know the answer to that, but we're going to find out. We're going to find out here today. So Oracle, though, I mean, these are huge numbers. That's talking about tripling or quadrupling their revenue. So, I mean, that's an incredible feat if they can do that. I don't know if they can or not. The market obviously is somewhat skeptical the stock would be a hell of a lot higher, but I put Oracle in my long-term account because those projections come anywhere close. This stock is going to be a lot higher in 2030.
Messy chart. That's all I can say. I mean, volatile and messy. I'll just go with 210 right now. Or excuse me, 310. Because you've had this whole move, this whole digestion. You have not been able to get back that all-time high. The one thing that's interesting to me is that the day that all the good news was delivered, like the best possible news, is that day that you made the all-time high and the all-time closing high, right? You had a decline that didn't quite fill the gap. Now the 50-day moving average is there. I would like to see a sustained bid over 310, 2, 3, 4 days in a row. Then I'd be more convinced that we're going back to that all-time high. But you see on the dips, there's people, willing to buy it. That 50-day right now at 271.26 is coming right in with the low of the move at 271. But we know this line's going to keep creeping higher, right? And higher and higher and higher. So maybe eventually gets up to that 280, 290, and then, it's more of a bona fide number. But for right now, you still have to say, since that earnings, or since that guidance that they gave, that the bulls are still in control. I mean, whatever way you look at it, the bulls are still in control of Oracle.
And the AI trade is still there. And I mean, we can talk about regional bank concerns. We can talk about a lot of other things, but the AI trade is real. And when I look at my long-term portfolio, I'm full of tech stocks. As much as I was bearish, last night, I still have long-term stocks. My RSP got killed yesterday, so it's good for it when the Trump put exists, for my long-term stuff. But I mean, bring up these regional banks. I want to bring up these regional banks here now because this was the talk yesterday, and it started with Zion.
Yeah.
So if you bring up Zion and look at this thing, the stock had its worst day in probably years. Stock was down 10 points almost, 46 and close 54, so 8 points down significantly here. This was a story that was flying under the radar early in the morning, but then started to pick up steam here, obviously as the day progressed. And they're talking about like two borrowers, related commercial and industrial loans extended. Brent, do you have all the details here in front of you? If you do, you can give them to us.
You did a pretty decent job there. Yeah, they basically were concerned with a couple borrowers that could have had bad loans, bad borrowers, bad loans. They were making already write-offs, charges, like a $50 million charge, another $60 million write-off to account for some of those bad loans. So, like what we were saying last night in SCN is like, if Zion's is a leader in this space, arguably, and they're carrying some concerning debts, some concerning debtors, I mean, is it happening elsewhere in the regional banks? And that's kind of the concern that spread around Wall Street and was kind of freaking some people out yesterday.
And this was the concern that was spreading around Wall Street 2 years ago when the regional banks, a lot of them fell 50%. We know we lost a bunch of them. And did they fix those problems? No, they never fixed any of those problems. I mean, and we did this in the chat last night. It's a good exercise. So asking everybody in the chat, what's your current mortgage rate? What is your rate? We want to just teach these regional banking problems. What is your current mortgage rate? Because like in Canada, they do a 5-year max. Like that's your max long-term fixed rate. So you can do 5 years. So, you're going to get reset. So when interest rates come higher, you eventually get reset. But when you look long-term rates, Stuart, 2.25, Mark's 2.62, Marie, 2.9, Reese, 7.37 might be in a different country. Maybe you're in Canada. If you're in Canada, I want to know if you're in the US only because Canadian rates are much higher here now. But 2.4, 3.2, 2.3, 2.82 for Brentster, 2.75. Oh, these are 30 years. So what the deal here is, when you are borrowing money at 2.5%, and the current rate is up at 3, 4, 5%, your bank is losing money to you. And they're not just losing money in the short term. They're losing money in the long term because these are 30 years in the U.S. It's kind of crazy. Who loans money? Who loans money for 30 years at 2.5%? some of these regional banks do that, folks.
A lot of them.
A lot of them.
Yeah.
That's stupidity. They got a lot of bad loans on the books. We've just forgotten about it. It's okay. If rates come back down, it's fine. When rates started going up, it was the concern 2 years ago, and then they just forgot about it all. But it's still there. There's still problems here, folks. So we've got to be aware that those issues still exist. Now, in Canada, they've all reset for the most part because they do 5-year max. So the Canadian banks are a little bit more cautious. They don't give out 30-year mortgages. But, I mean, that's like stems, and that's just not loans, mortgages. Then they do other loans. Obviously, there's other concerns here. So we're just trying to get you guys a feel for like why the regional banks maybe aren't the best place to invest. Now, if interest rates come down to where they're 2%, 1% again, all those banks start making money on those loans. But, you know, for instance, I was with Bank of Nova Scotia with my mortgage. I had, and this is Canadian, I had a rate of 1.64% for 4 years. 1.64 is one of my rental properties. 1.64. It's a crazy low rate.
That's wild.
I had cash, and I'm like, well, I'm not going to pay off anything. I said, slow the trickle down, like slow and pay that off as slowly as you possibly can. So we slowed the rate down and, you know, amortize out as far as you possibly can because it's just like free money. At the same bank, when the rates started going higher, I did a GIC, guaranteed investment certificate, with the same bank for 5.8%. I was making 4.2% off the bank, literally borrowing money from the bank for 1.64, investing with the bank risk-free at 5.8. So I was making 4.2% on Scotiabank for like a year and a half. But Scotiabank and the Canadian banks are pretty smart. They only do 4 or 5 year max. So when it came due, then the rate reset went way up. And then that game was over. And I took the money that I had in the GIC and I turned around and paid off the mortgage. That's what I did. So,
that's awesome.
But if you're in 30 years of that, and you start like 20 years left, holy crap, man. Like, these banks got a lot of bad loans on the book. So now we're starting to think about those loans again. Does it turn into something bigger? Well, it can. Can it be solved? Trump tried to solve some of it this morning just by popping the market back and bringing confidence back in. But the second thing is they could lower rates substantially and help these banks out too. So the cure is there, but this is just trying to give you an idea of what is happening behind the scenes. A lot of these banks loan money, sometimes to not great creditors, in the case of, you know, Zion, obviously maybe some bad loans in here, but just loaning money at too low of rates in a lot of cases.
And to that point, Dennis, we did have a headline yesterday that Fed Fund Futures, the CME FedWatch tool, had fully priced in another rate cut this year. And our percentage for 1% lower than rates are right now, so that's 3 cuts at the next 3 meetings, is almost 60%. So rates are, we know rates are coming down for sure. And I wanted to share something here on screen. One of our awesome users, Kirk, in the STN room, made us a little watch list of a bunch of regional banks, all the regional banks he could find, and he ordered them by performance month to date. And like, obviously, what do you know? Zion's is up near the top. He said the only regional bank over the last month, all the stocks he could find, the only one that was green was CMA, which we know is going to be taken over by Fifth Third. Exactly.
Yeah. I gotta hop in here on the CMA that people have been following us for a long time. I made a mistake in this, and I'm gonna take care of it today. I did buy that during the regional banking crisis, along with JP Morgan and another one that didn't work out so well. But my first instinct when that popped to $80 on the merger, I almost immediately wanted to get out. Like, immediately, just like, it's over. The trade is over. It's over. I want out. It's done. And I didn't. And that one thing we talk about a lot of times on these mergers, like that premium that you get the first or second or third day, there's no way to predict. You know, I didn't think anyone was coming into the 85. My first instinct was like just to hit the trigger. Like, it's done. And I'm also, I don't know about, I bought JP Morgan at the same time. I want to get rid of that too. I just don't.
I got you all scared. I'm not
I'm not scared. It's just, you have to take profits sometimes. You have to. You do. You have to sell. You have to sell sometimes.
Well, this is the deal. Like when you have all these speculative bubbles that we talk about, and all this speculation, comes into the market in 2020, and you saw these stocks like Upstart just going straight up, from 40 to 400, which it did in 2021. I mean, you're looking at this thing at $47 now. So yeah, indexes, hold your indexes long term. The market seems to go higher. But the things that make these things up change over time. And the reason that they change over time is because there's different companies. Like think about if you just said, I'm going to just invest all of my money in Sears. It's the best retailer in the whole world in 1965. You'd have been up so much money in 1990. You'd have been up huge. But then if you continued to hold it forever and ever and ever, eventually you lost it all. So these companies change. The companies that dominate your indexes in 1990 and in 1965 are completely different than the ones in 2025. That's why owning the ETFs is good. They keep flushing out the crap and putting in the better ones. That's a good thing to do. You got to do that with your own portfolio as well. You don't want to be long Sears and Kmart and, think about all the other ones, over the years that were awesome companies. Their time just passed. So I think you've always got to be flushing out the crap and putting in the better companies. I think it's just good exercise. ETFs do that, which is why ETFs are good investments.
All right, 8:31, as we mentioned, it is an options expiration Friday, and we got a special guest, and we got a little treat here for CC. So Brett, roll the intro.
Yes.
Wow. That was awesome. That's the first time I saw it. That Josh, he's talented in the background there. That's awesome.
I've been asking for walk-up music for 2 years.
We got it. See, part of the Stock Trader Network team here, obviously, we're working with Options AI very closely. You are our seasoned options trader here on this team. And we have an options expiration Friday here, which looks like it's going to be a good one because we were down 80 handles an hour and a half ago. And then Trump comes out, says, I don't like the market down, talks about China, says tariffs aren't going to last, and we get it all back. We rally all the way back up. So now as an options trader, how the hell do you approach a day like this?
But real quick, CC, for the rest of the intro, I either want you to do the robot or the moon dance or something like that. Okay, doing the
Yes.
Okay, get to Dennis's much more important question.
Yeah, here's a little it's almost like an admission of guilt of being somebody that talks about options. Is a lot of times people will be like, oh, it's an options expiration, it's going to be crazy, or it's triple witching, which I've always joked with you guys is like the best branding ever, right? Typically 8 out of 10 times, let's say when I'm coming on the show for an options expiration, the options market is actually having the opposite effect of making the market exciting, right? So we've talked about this on prior expirations where it's like you can almost expect some sort of pinning action. And a lot of times those days leading into an expiration, the options market is actually dampening moves. And then, as we've talked about in the past, that next week is usually when the market is allowed to open up in those conditions. Now that's 8 out of 10 expirations when the VIX is 15, let's say. This week is one of the 2 or 1 out of 10 where it's the other way. And so some of the action that you've been seeing the last couple of days, and I think there were a couple of days this week where the SPX was pretty much unchanged or close to unchanged. Yet if you were trading, you're like, that was nuts. It was, up, obviously last Friday, I think was like a 3% range, but we've had multiple more than 2% ranges this week in the, in the market. And the options market, this is one of those rare cases where the expiration is actually adding to that volatility. And the reason that's happening is when you're facing normal conditions going into an expiration and the VIX is 14 or 15, you're generally in an area of the market where a lot of institutions and even retail traders and all of these, options enhanced ETFs and all, you're running into places in the market where a lot of calls have been sold, right? And it kind of has this dampening effect on the market. As of last Friday, it was the exact opposite, where everyone raised. Nobody had even thought about protecting their portfolio in like 3 months, right? And so last Friday, all of a sudden, the fear of God is put into everyone. And they're like, oh my God, the market can actually go down like quickly. And so everybody raced for protection. A lot of it was this Friday. And then we'll see some effects, you know, sort of like going into year end from this, if this lasts. But the opposite happens, where people have raced for near-term protection. They've raced for short duration protection. We've now gone from last week, where we were up until Friday, where we were pretty consistently pricing in about a 0.4% or not even expected move every day in the SPX. Coming into today was a 1% expected move. It was basically the biggest expected move, really, if you going back to spring, right, in the initial tariff tantrum. So vol exploded. And Dennis, I was watching your intro with the taco thing this morning, right? And I think you're absolutely correct. And I had to look at the overnight VIX. It hit 29 overnight.
Wow.
So we're back below 24 in the VIX, but you're looking for those capitulation moments and the timing of like that, you know, tweet. And then I would say you all also hit, you know, some of the regional banks. I think one of them was upgraded, one of them, you know, this morning. And then obviously I think another reported this morning.
There's a bunch that reported that we're okay.
Yeah, if there's some sense that this isn't like systemic and it's just some, you know, a couple of banks made really dumb loans. I mean, so the point being is that the volatility that we saw overnight is directly affected by this expiration and all these options positions, because as it's going lower, Citadel's selling stock, Jane Street selling stock, everybody's selling stock, right? That have to like kind of protect all of the puts that they're suddenly short. And there's really no down stop. Like we could have, if had this taco thing not happened, this could, and you know, it still could be, but probably not. We're back to unched or whatever. Yeah. This could have been a really ugly day. So let's say if the headlines had been the opposite this morning and Trump was like 200% tariffs.
Oh my God.
Right? This could have been one of those like down 5% days, because there was nothing in the market like support wise in options. You already had people spooked. You had the regional bank stuff on top of it, which anytime anybody hears anything about banks, it really freaks them out, obviously. And so this was set up to be a volatile day, and it might not be over. We could, you know, Joel, you were saying we might not have even seen the high. We could rip 1% from here. We could immediately retest those overnight lows, like on the open, you know, right after the open. So we're sort of set up for some wildness, and that's kind of rare.
Before we go to your chart, CC, I mean, you have the big boys, you know, offsetting their hedges, but there's also people out there that had the puts on, right? Yeah. And they're like, are puts on a stock. Yeah. And it's some outrageous price. And like, so they can buy the stock, right? Yeah. If they're covered, I mean, you know, what if you have, I'm just throwing something out here, like a 320 put in Oracle that looks like it's going off the board. I mean, so there's a lot of hedging effects that come in on both sides. People that are behind the 8 ball on the hedge, and the other people that are, you know, benefiting from the overnight action. So
totally.
Yep. So let's go to some setups here. One thing we like is, you know, your consistency. We've been following your stuff. You know, not only on the options expiration, but every Friday. Pull up. What do you have for us?
Well, if you want to share your screen, that'd be good.
Yeah. Are we up there?
Yeah, we are. Here, we're gonna add it. Actually, it's already up here. Sorry. We'll add it right now.
So one of the things, you know, like Joel and I have been doing the Friday afternoons, and this is kind of, you know, so for the last, I would say month, we were talking about year end, looking out to year end. This is when the VIX was 15 and it was starting to creep higher. Like it was signaling something was coming, you know. It was impossible for them, you know, the banking, when you look at the banking and the regional bank thing, all of those like private equity firms and some of those regional banks and all, they've actually been under pressure. Like when you go back, it didn't just start this week or yesterday, right? You know, some of those KKRs and Ares and, you know, that private credit, and, you know, it's been a story that's kind of been bubbling up. I don't know if that necessarily had anything to do with it. The tariff thing obviously came out of the blue, but there was a general, you know, volatility had started ticking higher, I would say, the last 2 to 3 weeks before all of this went down this past 5 days. Now, I would have thought at the time, and the way I would have explained that is we were about to break out, and IWM was about to break out. You were seeing all kinds of, you know, speculative froth. You know, Bitcoin hadn't done its thing yet where it reversed. And when you have a setup like that, and I think, Joel, you and I talked about this on one of those Fridays, is the VIX was 15. It was starting to creep up to 16. We were either going to break out and do a party like it's 1999 moment, or it was going to be this head fake and we were going to fail. Either way, volatility was going up, right? And so, you know, you and I on the show, we were looking at, you know, if you're going to hedge into year end, how do you do it? And I was basically saying, just kind of pick your spots. You could buy a put, you could, you know, hedge it, you could spread it later, or just do an initial spread into year end. Go out to, like, you know, maybe before Christmas or at least past Thanksgiving, and kind of set yourself up. And that way, the explanation for a hedge would be, what can I spend that I expect to lose, right? I'm going to lose this 70% of the time or 80% of the time, my hedge. But if it does come into play, it allows me to actually follow through with my plan. If the market pulls back, I get to chance to actually buy rather than be panic sellers like everybody else that morning or whatever. So we talked about a couple of, you know, right now we're looking at a Qs trade that we looked at, and you can see this is basically, it's kind of hilarious. So we set this up so that this break even would basically catch these very recent lows, and look exactly where we've bounced the last couple of days is right at that break even. And we did the same thing this morning. This isn't showing the pre-market action, but this break even in the Qs is 589, right? And the point of this trade when we discussed it was, you know, if you got a 10% correction or even a 7.5% correction in the Qs, in the SPY, you know, where would the break even be? The break even at the time when we looked at this trade was just, you know, the prior week's lows. And then it basically is taking you, this trade, if you can see, it's taking you back down to, like, you know, pretty close to these breakout areas. And the point being with a hedge like this is, if you did get this move, if we went down to 540 in the Qs, which is not completely, that's not that big of a move, right? Then all of a sudden you're like, okay, this is the spot. This is where I wanted to buy NVIDIA. This is where I want, you know, I on my shopping list, if NVIDIA ever came back to 150, I'd be a huge buyer. Well, a lot of times NVIDIA goes to 150 and everybody's like, oh man, the world is ending, right? So those are the kinds of things. Now, the question now, and this is sort of a little bit more complicated, is that we're basically looking at, you know, in the case of the Qs trade, we're looking at a trade that we did, you know, it's now it's a week ago. So, and the VIX was, you know, it going before the reversal last Friday, the VIX was, I think, 16, maybe, let's call it. So now the VIX is 24. So things are a little bit more complicated. Let's just look at like IWM, or let's look at SPX, because this is, I actually, in my memory, I remember when we first started looking at these trades, what the vol was out at the end of the year. So we're looking at, this is an SPX expected move chart out into year end. It's about 6.5% expected move to the year, to the end of the year. That's 18.5% IV out there. This was 14 when we first started looking at this a couple of weeks ago. So what I would say, the only thing that's changed is you kind of have to balance two things. Is you never want to buy options when vol is really high, but at the same time, we haven't gotten the market move. If we finish green today, what are we, 1.5% off the highs? I mean, we've barely moved. So you kind of have to like kind of balance in your head, is the delta more important, or is it that I'm overpaying for option vol? And in this case, what I would say is if you were looking at like Qs or IWM or anything that you feel like you have, you know, particular risk in your portfolio, and everybody has Qs risk right now because everybody,
sure,
whether you know it or not, like 50% of your portfolio is NVIDIA and Microsoft and Broadcom. Like it's such a massive part of your portfolio right now. So I would argue like Qs and things like that. I don't think it's too late. And I think you could go out to, you know, Christmas time, let's say, and look at some put spreads very similar to that Qs that we looked at. You know, if you're looking at IWM, it's like, you know, can you do a 240, you know, 200 or 210 put spread? I think that kind of stuff makes sense as a hedge.
There's so much stuff to just chew on here. And, you know, I think it all comes down to we're very close to highs. Like it's a weird market because we're so close to all-time highs. But then you're saying like now insurance is starting to get a little bit more expensive than it was last week. So we all should have bought insurance last week. You know, now we're like, oh, now I want to go out and buy insurance. And I mean, the question just comes back to, are we now paying too much? Do we want to wait till the dust settles? How quickly does that IV come back in? Like, that's what my question is to you. Like, how quickly, you know, we go from 14 to 18. How quickly can that come back in? Can I get a shot at getting back in with IV at 14?
You 100% can. So what's going to happen is this kind of stuff tends to linger. So let's say the tariff taco thing plays out like we all sort of suspect it's going to play out, right? Which is like, you know, maybe there's another angry tweet on Monday or Tuesday or whatever, but it's kind of, you know, the dust is starting to settle on that. So then let's say the banking crisis, it's just like, oh, it was a couple of dumb loans, but there's nothing systemic. There's no systemic risk.
Sure.
This isn't JP Morgan, you know? This is Fifth Third Bank Corp that everybody was worried about this morning, right? In Zion.
Yeah, Zion.
Yeah. And so that kind of, if that dust starts to settle, you're going to see a VIX back below 20 pretty quickly over the next couple of days if we did actually put in a low overnight just now. And then at that point, I would say, listen, if you're spending money on a hedge into your end, you're probably pretty fine. You're not overpaying that much. And to your point, you haven't given up on the market move. You know, it's not like you're buying the VIX at 30 when the market's already down 10%. That in that case, I would say, no, absolutely do not buy any options right now. You know, it's too expensive and we're probably near an inflection point. In this case, it's like, yeah, you know, the VIX hit 29 this morning, and that was probably an inflection point, but you haven't gotten your market move yet. So if you just buy like a put spread, I would say don't buy a put, buy a put spread as a hedge. You're probably fine because if you get your 7% move, who cares what vol you paid for it? You know what I mean? Like if the market falls, like who cares? So I would say that, and then not to sound, you know, we've only discussed kind of bearish trades here. You know, I would say, you know, we're looking at this. This is actually, if people want to like write this down in IWM. This is like a 245, 225 put spread out to, what did I select? This is December 19th. I always like to do actually a little bit like before the holidays because vol gets crushed in the holidays. So if you look at this on a chart, like this IWM trade, your break evens at 239, you know, $6 below here, which is nothing, or $6 below yesterday's close. And then you're protected in this, or if you were doing this outright, you know, basically for a 8% move lower. You know, this is a 20 wide, you're paying about 5.5. Let's say you could probably get this on an up open, you know, and you're protected for 14.5, to $15.50 to the downside. So I would be doing something like that. In this case, you're buying a put for 10, but you're selling one at $4. You're taking $4 of the premium away by making it a spread, and you could make it wider or anything like that. The other thing, before we sound like completely, sort of bearish, because these are hedges and they're not necessarily bearish. Like, I don't mean them to be that way. I mean them to be potential ammo if you did get a pullback here. The flip side of that is, man, like 6 days ago, had we been talking, I would have been like, man, we are about to absolutely go ballistic to the upside. It really had that feeling, right? Mm-hmm. And it may have turned out to be a head fake, but there were like, I mean, every morning it was like something crypto related, something AI related, something. You're starting to see those headlines where everybody's just sort of saying, oh, we've teamed up with OpenAI and the stock's going, ballistic. Feels very, very late 90s. In those cases, to the upside, what happens in those kinds of stocks, and we've what's one that's like kind of still gone ballistic? Dennis, what's your favorite like crazy stock right now to the upside?
Well, I mean the quantum names, if you wanted to go like, and they did sell off the last couple of days, but you could go like an RGTI, like that thing's just been going nuts. It's went from $10 to $55, and it did sell off like $7 yesterday, but it's just been going berserk.
As I said that, I just remember gold's chart last week. So gold is a perfect example, and like, the RGTIs and everything else looks exactly the same. So typically what would happen in a stock or an ETF or anything is as it goes higher, the volatility would go lower, right? So, as the SPY and the Qs and even IWM to some extent under normal conditions, when it's going higher, vol goes lower. And then when it goes down, it's the escalator up, elevator down, right? When stocks break out, or when you have something like whatever's going on with gold, which I don't think anybody can totally 100% put their finger on right now, it's the opposite. When these things rip higher, the vol expands, the vol explodes. And you're seeing that with some of these, sort of smaller names as well. So in this case, what I would be saying is, I tried to short gold last week. I'm like and I did it via
short. You can't shorts. Oh my gosh.
But so the way I did it was I did and I think I still have it on here, but it's like a complete loss at this point. So look at that. So there's my trade down here, right? And what it was GLD at like 370, which seems so quaint at this point. This was like a week ago. And I was like, all right, if GLD pulls back from here, which wasn't an insane idea when you look at that chart, I was like, what happens is the volatility actually compresses when it goes lower. And when it goes higher, the volatility actually goes higher. So that's my dumb trade, right, from last week. But if you were to say, what is going on in gold? I have no idea. There's no way I would buy GLD at 396, but this is kind of fun and I want to see how it plays out. And I would like to, expose some upside where if I'm wrong, it's not that much money. In these cases, you want to be doing call spreads, because what's going to happen is you generally are going to see much higher volatility, implied volatility in the options to the upside than to the downside. And so in this case, we're looking at, let's go out to like the Halloween or whatever. So in this case, the at the money options, and I'm just looking on the chain right here, the at the money options are, they're 33 vol. As you go higher, we're seeing like 35 vol, 36 vol. So you're actually the at the money options in a stock, in an ETF like GLD or any of those, small cap, like kind of quantum names, or like I even saw like drone companies and things were going higher. So all of those kinds of names, the upside is going to be more expensive. So what you can do, what that allows you to do, is it allows you to buy a call close to the money, sell to all the people on Robinhood that are scrolling the chain for the cheapest call they can find. And you're actually using their exuberance to help pay for your slightly more rational bet, which is closer to the money. So I would suggest, if you're looking at these names, and let's say even today, like some of these names, Dennis, that like, you know, some of these parabolic names that have been parabolic recently, probably a lot of them have been hit the last couple of days. Look to go make some plays back to the prior highs where you're sort of buying an at the money call and then you're selling a call up at those prior highs, because you're going to get really rewarded volatility wise. The market it becomes very inefficient in names like that.
Awesome stuff. Joel, you're on mute. He does it. He hasn't done it in a long time. You know what? I'll give you a break, Joel. You haven't done it in a long time. He's still mute. Joel, it's muted on the STN. There you go. On the StreamYard.
Okay, so if I drink water and I slurp, then you tell me I'm
just don't
drinking water. You're never happy.
Why do you have to drink every show?
Glad you're out on Monday.
I don't have water here.
Oh, Trent, we get a vacation on Monday. Oh, thank you. CC, quick question here, and I had the question loaded up. And okay, so Garen, who I think is new to YouTube. Hello, Garen. Welcome to our show. So what does CC say with buying these puts or put spreads? We should have a decent amount of cash, so when it gets there, we buy?
Absolutely. So what I would look at it as, I mean, there's two ways to think about it. If we were entering like an extended period of volatility where you kind of wake up in the morning and you're checking the futures at 5 a.m., you know, it's not healthy, right? Not healthy. Sorry, Dennis, but like,
I'm not healthy. I get up at 5 o'clock. I go swim at 2,000 yards. It is healthy.
Yeah. So, but yeah, if you're worried about like you can barely sleep and you're getting up in the morning because you're worried about your portfolio and all, like that's worth some money, right? To be able to sleep. So think of like a little bit of a hedge going out a couple of months. You're like, man, if it really gets ugly and all my neighbors are like, you know, selling their cars and stuff, I'll be fine. So that's one thing. And then the other thing is exactly to that question. I always look at hedges, you know, just going back to, there's that Rigetti trade, by the way. That's pretty.
Oh, bring it back up.
So
what's up?
I couldn't help myself. So this is like October 31st. Can you see it?
Yeah, we see it.
Okay. So, you know, this is buying like a 48 call, right? What are we trading? 46.5 right now.
Sure.
And selling the 60 call, and you're absolutely getting rewarded for selling that 60 call, because everybody, you know, at home has paid. So the 60 call is 185 vol, and the 48 call, there's about the same. And this is what happens is it corrects. As the stock pulls in, volatility collapses. When this thing starts ripping higher, all of a sudden those that upside is going to get bid up. So you kind of want to like time it well. But yes, this gives you a break even of about 51.64. You're risking about, let's say, 350, you know, especially with this open, you're risking about 300 to make, you know, possibly 900. So that's the kind of setups you want and stuff like this. And it's like going back right to those highs from a couple of days ago. But going back to, let's say, the QQQ trade, I got sidetracked because I had pulled that up while we were talking. So that the QQQ trade, this is literally to that question. This trade is exactly intended so that if the Qs went back below 550, that you would have ammo that would allow you to buy down there, right? And it doesn't need to be Qs, obviously. But Qs is so heavily concentrated in the kinds of stocks you would want to buy. If you saw a pullback of 7 to 10%, you'd be stepping in to, like, you know, take your shots in NVIDIA and things like that. Because NVIDIA would be 150 if that happened, right? And you want that ammo, and you could do it in an NVIDIA. Let's say you owned a bunch of NVIDIA right now. You would want to be hedging down to 150, I would say. And that would give you, let's just do real quick. This is December 19th, put spread. That would give you, let's look at it on the 1 year chart. I mean, you can make this even lower. I'm going to take the short put down to 150. And then, so let's do, this is a 180, 150 put spread, right? And you're risking about 9 to make 21 on this. Your break even's 171, which is only $10 lower in this. And you're protected. And then if you basically got down to 150, you would have ammo and you would have cash ready to, buy NVIDIA down there. And it's much better than like puking NVIDIA down there because you don't have any stock. Or you don't have any.
CC, gotta hop in here. Yep. They'll just want to add a quick programming note. We want to add more content to the STN and YouTube. We are going to be adding a show at STN hosted by CC, Options Unchained. Was that going to be a good one? So CC, we got a lot of catching up with you to do. Thanks for the education. We'll be talking to you very, very soon. Thanks, CC.
Definitely. See you guys.
Awesome stuff, CC. Love having you.
Okay, we are up against the clock here. Brentster, did you have one thing for us?
Yeah, I want to say thank you to our wonderful host, Hive, wonderful sponsor, Hive Digital Technologies, a global leader in green powered data centers for Bitcoin mining. Let me get the overlay up here.
Yeah, let's do it.
Have a little overlay. There we go. Hive Blockchain is a global leader in green power data centers for Bitcoin mining, high performance computing, and AI, operating nearly 0.5 gigawatt of renewable energy. Hive is on track to capture 3% of the world's Bitcoin production by the end of this year. Scan the QR code in the bottom right corner or click in the link in the description of this YouTube video to learn more about Hive Digital Technologies. Thanks again to Hive.
Okay, folks.
Wow.
That's it.
That was a power 30 minutes with CC, though. He's awesome.
Really
I'm so
was.
glad, like we've been looking for, like, obviously we've been working a little bit with CC. We're going to be working way more with him, bringing you way more CC Lagator content because nobody knows options better than this guy. Like, this guy rocks, from the floor, like market maker and options. I mean, his background is just unbelievable. He can tell you, so many different things that I don't know either. It's just, it's an unbelievable, add to the Stock Trader Network here, having him as part of the team. So we're very happy to have CC and be working with Options AI to bring you more options content on a regular basis.
All right, folks, that's it for today. Thanks for joining us for a fun week on Pre-Market Prop. We'll hear from Craig Johnson on Monday.
Stock
Be
Trader
safe,
Network.
everybody out there, and treat each other with respect.